Hi there, this is Simon, personal finance coach. The latest consumer price index, CPI, of 0.4% for March 2024, published this Wednesday, showed that the annual inflation increased to 3.5%, higher than expected, and marked the largest annual gain in the last 6 months. The current inflation rate signals that the highly anticipated rate cuts investors were expecting may not come this year. Instead, investors may need to expect more rate hikes as interest rates are already at 23-year high. So why is inflation inching higher? The three main factors contributing to the stronger than expected inflation in March were gas prices, rents, and car insurance. Rising gas prices stem partly from growing demand and partly from geopolitical tensions. Rents remain sticky due to nations' light housing supply, and car insurance rates surged 22%, contributing to inflation acceleration. So how will inflation affect equities? With inflation staying steady above 3% or even going higher, it is a good time to revisit the best sectors for inflation in the shifting economic environment. Research done by Schroders Investment Management has found that in the past 50 years, equities outperformed inflation 74% of the time when inflation was high, above 3%, and was falling. However, when inflation was high, above 3%, and was rising, equities performed no better than a coin toss at 48%. So which equity sectors may offer shelter against rising inflation? The same research has found that not all sectors are equally affected by inflation, and some are more resilient than others. The impact of inflation on earnings will vary by economic sectors and its ability to pass on higher costs to customers. The x-axis on the graph shows that the percentage of yearly periods from 1973 to 2023 in which equity returns exceeded inflation in high and rising inflation environments. The y-axis on the graph shows the inflation-adjusted return achieved during these periods, a measure on how much they have beaten inflation by on average. The energy sector, which includes oil and gas companies, beat inflation 74% of the time and delivered an annual real return of 13% per year on average. This is a fairly intuitive result. The revenues of energy stocks are naturally tied to energy prices, a key component of inflation indexes. So by definition, they generally have performed well when inflation rises. Equity REITs, real estate investment trusts, outperform inflation 66% of the time and posted an average real return of 4.6%. This makes sense too because equity REITs own real estate assets and may provide a partial inflation hedge via the pass-through of price increases in rents and property prices. The other two sectors that outperform inflation over 55% of the time were utilities and consumer staples. To summarize, U.S. equity sectors that are likely to beat inflation in high over 3% inflation and rising inflationary environment based on 50-year history are energy, equity REITs, utilities, and consumer staples. U.S. equity sectors that are not likely to beat inflationary in high over 3% inflation and rising inflationary environment based on 50-year history are mortgage REITs, consumer discretionary, telecoms, and IT with long-term cash flow. The track record for all other sectors is mixed. This is the playbook to hedge against inflation in continuously rising inflation environment. Please subscribe to this channel to receive updates on the future videos, and thank you for watching.